Fundamentals of taxation. Nature of taxation. Taxation is a state power exercised through the country's legislative body. The principle of taxation states that taxes are collected to support the government in its expenses and services for public welfare. Purpose. The purpose of taxation is to raise revenues from all possible sources to support government expenditures and services and to promote the general well-being and protection of its citizens. Taxes safeguard newly opened industries to pioneering and new industries and other enterprises. Taxes also shield domestic producers by levying a much higher custom duties on imported goods. Tenets of taxation. Refer to the basic principles of a sound tax system. Fiscal adequacy. Taxes collected by the Bureau of International Revenue must be sufficient enough to fund the necessary government expenditures and basic services in a given fiscal year. Revenues must be capable of adjusting to variations in public expenditures. Administrative feasibility. Payment of taxes must be taxpayer-friendly, means that tax laws should be capable of convenient, just, and effective administration. Citizens must easily understand its application for its compliance, no matter how willing and able a taxpayer in complying the mandate of a tax law. If he could not comprehend, he could not fully comply the same without lapses. Notably, each error in compliance is penalized and good faith is not always a good defense. Theoretical justice. Ability to pay principle. Equality or theoretical justice, which means that the tax burden should be proportionate to the taxpayer's ability to pay. This is the so-called ability to pay principle. Basis of taxation is based on the reciprocal duties of protection and support between the government and its people. The Constitution, the fundamental law of the land. Statutes, laws passed by the Congress or presidential decrees. Bureau of International Revenue rules and regulations. Judicial decisions on tax cases by the Supreme Court. Provincial, city, and municipal ordinances. Observance of international agreements and administrative rulings and opinions. Objects of taxation. Persons, natural or juridical. Individuals who earn a considerable amount of income as a worker or as a businessman in partnership, or corporations, including those who inherited a property or given a gift or donation of a considerable value. Properties, tangible or intangible, real or personal. Tangible and intangible properties, whether personal properties, movable properties that can be moved or relocated, or real properties, immovable properties. Excise objects. Transactions, privilege, rights or interests, such as imports and exports. Situs of taxation. Situs is a Latin term for place or location. It refers to the place where taxes are to be paid. Income tax. This is paid either in the place where the income is earned or the place of residence of the taxpayer. Real property tax. This is paid where the property is situated. In the Philippines, real property taxes are imposed only by the local governments on real property situated within their jurisdiction. The real estate is subject to taxation in the state in which it is located, whether or not the owner is a resident of the said jurisdiction. Personal property tax. Taxes on intangible properties are paid in the place where the property is located, similar to real property tax. Situs of taxation of intangible properties is the owner's domicile. This refers to the place of permanent residence of the owner. Intangible personality such as credits, bills receivable, bank deposits, bonds, promissory notes, mortgage loans, judgments, and corporate stocks do not admit of actual location and as to such property. Business and occupation taxes. This is paid in the place where the business or occupation is located. In the Philippines, the taxes on business, occupation, and transaction are the VAT, percentage tax, and excise tax. Limitations of taxation. Inherent limitations are rooted in the nature of taxation itself. These are the limitations that are not affected by changes in the provisions of the constitutions. The tax revenues must only be used for public purposes. It is an essential characteristic of the power of taxation that the tax is imposed for a public purpose and not for a private purpose. It should be for a governmental purpose, for the public welfare or the common good. There should be proper delegation of legislative power to tax. As the nature of the power of taxation, it is legislative in character. That power cannot be delegated to others. When the state grants taxing power to another agency, then that is a violation of the inherent limitation. Government entities are exempted. Government immunity from tax. This is a self-imposed practical limitation that the government does not tax itself. The government exercising governmental or sovereign functions is not taxed, but when the government agency exercises a proprietary function, taxation is the rule. There are territorial jurisdictions. The power of taxation is limited only within the boundary or territory of the state. The state cannot exercise its power of taxation outside its territory. If the subject of taxation is found abroad, then the state could not anymore tax that. There is an observance of international law. The power of taxation is imposed only within the state. The state could not tax another sovereign. Under the principles of international law of which we adhere, this is on the basis of Article 2, Section 2. Constitutional limitations of taxations are those limitations provided in the Constitution. These limitations are more subject to change when a new Constitution is introduced in the country. Observance of due process of law. In Article 3, Section 14.1 of the Constitution says that no person shall be held to answer for a criminal offense without due process of law. When the state exercises the power of taxation, the taking of the property should be subject to due process. There must be a basis for the taking. If the state exercises its power outside of its territory or when it taxes another sovereign, it is also a violation of due process. Equal protection of the law. No person shall be deprived of life, liberty, or property without due process of law, nor shall any person be denied the equal protection of the laws. Article 3, Section 1. Equal protection refers to the idea that a governmental body may not deny people equal protection of its governing laws. The governing body state must treat an individual in the same manner as others in similar conditions and circumstances. Uniformity and equity rule. The rule of taxation must be uniform and equitable, and likewise progressive. Article 6, Section 28.1. There is no more distinction between equality and uniformity in taxation. Equitability or equity in taxation based on one's ability to pay. and imprisonment for non-payment of poll tax. No person shall be imprisoned for a debt for non-payment of a poll tax. Article 3, Section 20. A poll tax or personal or capitation tax is a fixed amount imposed on individuals residing within a specified territory without regard to their property or the occupation in which they may be engaged. No appropriation for religious purposes. No public money or property shall be appropriated for the use of religious purposes. Article 6, Section 29.2. Directly or indirectly for the use, benefit, or support of any sect, church, denomination, sectarian, institution, or system of religion, or of any priest, preacher, minister, or dignitary as such, except when such priest, preacher, ministry, or dignitary is assigned to the armed forces, or to any penal institution or government orphanage or leprosario. Article 6, Section 29.2. But charitable institutions, churches and personages, or convents appertinent thereto, mosques, non-profit cemeteries, and all lands, buildings, and improvements actually, directly, and exclusively used for religious, charitable, or education purposes shall be exempt from taxation. Article 6, Section 28.3. Double taxation refers to an instance when an income, a property, or a transaction was imposed with the two or more taxes by taxing authority in the same year. Occurs when an object of taxation was levied with two or more taxes from a single tax basis. Direct duplicate, same income tax twice. Indirect duplicate, taxes that are paid by the same individual or corporation based on two or more different taxing bases. Now, whether it is a direct duplicate or direct double taxation, or indirect duplicate or indirect double taxation has been called as not to be prohibited. Double taxation is not unconstitutional. When you have a law that was enacted resulting in double tax, you could not invoke double taxation because it is not unconstitutional. The manner of attacking that law should not be based on the argument on double taxation, but it should be attacked on the basis of constitutional or inherent limitations. The question of government taxing itself. The government may be taxed if it derives profit in the exercise of its proprietary capacity, and not when the revenues were gained from the exercise of governmental responsibility. The government functions in its governmental capacity when it serves the people and delivers basic services to them. The government acts in its proprietary capacity when it functions for profit. Avoiding taxation. These are the other concepts related to taxation in terms of avoidance or non-payment. Shifting. This is the passing on of the tax burden from one person to another. Shifting is peculiar only to certain forms of taxes, and this is peculiar only in indirect taxes. There is no shifting in the case of direct taxes. Example, VAT, percentage tax, business tax. Tax capitalization. This is done by reducing the price of a taxable product or service to lower the tax that will be imposed on its consumption. Example, sale of real properties where you have savings, acquiring the property at a lesser price. From that savings you have, the savings will be capitalized to pay your future tax obligations when you would now own that property. The future taxes on the property sold are capitalized at the time of purchase and deducted lump sum from the selling price. Tax avoidance refers to the availing by the taxpayer of legally allowable means in reducing or minimizing the tax due on certain properties, items, and services. Is the use of a legally permissible method to reduce tax payment, or what we call tax minimization. Tax evasion refers to the use by the taxpayer of illegal means in escaping, defeating, or lessening the tax due. It is also known as tax dodging, and it is also punishable by law. Tax exemption. This is a grant of immunity to particular persons or corporations or to persons of a particular class from a tax, which persons are generally within the same state or taxing district who are obliged to pay for the tax. It is an immunity or the non-payment of a tax. Transformation is effected through the process of production. The producer on whom the tax is imposed, fearing the loss of his market if he adds the tax to the price, takes the tax and recovers his additional expense by improving his method of production, thereby turning out units at lesser cost. This is peculiar only in the production process, when you are a manufacturer or a producer. When one improves his means, methods, or manner of production, this would turn out more units at a lesser cost. The tax is transformed into a gain through the medium of production.